talking about Microsoft today. MSFT on NASDAQ. Put out the quarter. Absolutely great quarter. Fantastic. I don't really think you could have expected much more. Yet the market sold it off a little bit. It's only down about 1.4 as I'm recording this at 10:15 on the day of the release. I would not get hung up on the market selling this thing off. Who knows why specific investors are selling it. Maybe they're momentum investors. You know, the stock has run up. You use earnings as a good reason to jump off. It's not going to get any better than this. Like, I mean, you'll hear a lot of things. And none of them are valid in my opinion. I will say this. I think it might be an indicator that the market itself, the whole general market, is getting a little rich, which I think, you know, you can make that case in a number of ways. And, you know, Microsoft selling off, an absolute giant and darling, sells off on a pretty darn good report. That's the only thing I would take out of the trading aspect of it. The actual earnings itself can't ask for any more. Okay, cannot ask for any more. And it's not taking me off the stock at all. In fact, if anything, I would add to it. Okay, so revenue was up to 38 billion, and that is a 12.8% increase over the previous year, which was 33.7 billion. It beat analyst estimates of 36.5 billion, so that's a 4.2% beat. Earnings per share beat was 6.2%. They posted $1.46 versus $1.37 expectation. Now there's a little bit of a weird accounting thing here. Earnings per share was down 14%. So this is why we don't use earnings. There's always something in the earnings that messes it up. I mean, there's lots of clean quarters, and when they're clean, earnings is a fine number to use, but there's always just something in there, either, you know, a depreciation, a one-time charge. It's also not as good an indicator as cash flow about value, because you can spend cash, you can't spend in earnings. So let me show you that a little bit as well, and I think it'll become obvious why, you know, earnings in this case in particular is not the best indicator. So let's jump over there really quickly. Okay, so here you see the earnings line. It's about halfway up your screen. Let me highlight it for you. There you go. Okay, so dating back to June, these are all quarterly. The June 2018, it's $1.16, $1.15, $1.09, $1.15, and then it jumps up to $1.72. That's the quarter we're comparing this one to. You know, then it drops right back down, $1.40, $1.53, $1.41, and then the one that was just reported was $1.46. So this 172 is just, I mean, just clearly, without knowing anything, like, there was something in there that it's not an everyday operating one-time gain or something right there. There's no way that it's not logically consistent, right? So let's not get hung up on that, because when everything else you compare to, you know, revenues, you know, slowly but surely moving up at a steady rate, margins are staying roughly the same. They were down like by 1% this quarter. No big deal. Okay, now jump into the valuation. Okay, so the valuation, and as I said, the market as a whole might be getting a little rich. And even Microsoft perhaps is a little rich, but I don't think so. Now, you see our model, it clearly says overvalued. This is the default though. The default, by being conservative, this is how we designed our software, to be conservative. So we fade everything. So, you know, you're earning a good return, and then we you know, taper that off. And I just don't think that that's actually a very good model for Microsoft. So we have the ability to change that as analysts and as thinking human beings, and what is really going on. Okay, so let's do that. Let's do that exercise. Let's try and be quick here. First of all, let's just use plowback. So whatever money they earn, they're going to put it back into the business. And if they don't, they're going to repurchase shares or something which is beneficial to you anyways. Okay, so as you can see, the return has been moving up for the last 5 years, down from 12 up to 18% now. The reason I'm so bullish is that the business model itself is now a recurring revenue business model. right? So there's no reason to expect it to be a boom and bust the way it was in the past. In fact, you can see the boom bust right in our graph right here. So it went down to as low as 7% in 2004. And then a boom, a release of Windows or Office or something, and everybody buys it, and then they own it, and then they don't buy it for several years, right? And then you see the taper off. Well, that's not how it's done anymore. It's a subscription fee, and that was my signal way back here. I actually started buying the shares way back 5-6 years ago, as earnings per share, or sorry, as the as the subscription model started to take shape. Now, it took a bit of time, because you go from getting $500 a pop to more like $100, but every year, it's a different animal. It's going to look different in your financials, and it's going to hurt you for a couple of years, but then it's going to get more and more powerful and more steady and more reliable. Okay, so that essentially comes down to what we call a fade. So I do not think this fades. In fact, I think over the next 5 years, we're going to continue this trend, and I think we'll be up to, I don't know, I'm going to say somewhere around 22. I'm just going to use 22. I think it's fair. I think it makes sense. And all of a sudden, our valuation jumps up quite a bit to 178, trading at 210. Okay, obviously we're not there yet. Are there other levers we should? Well, there's other levers we can pull. Are there levers we should pull? And the answer to me is absolutely resounding yes. I don't think this company fades now. It doesn't have the boom and bust of new releases anymore. I don't think any of their business is like that. I think the whole entire business is sustainable, recurring revenue type thing. Okay, so let's try 6% fade instead of 8. So we're gonna, the steepness of this slope. And all of a sudden, oh, well, that's worth 242, trading at 210. Okay, now that's not bad. That's at least some upside. Now let's talk about what it earns in the long run. In the long run, we're saying 8. Well, even in the boom and bust days, the worst was 7, and we think those days are kind of gone. Let's just try 10. And we're doing some of this is sensitivity analysis. It's not. I don't always put a target on something. I do sensitivity analysis constantly, and I think that to me is actually more insightful. So 10 gets us 276, 12 gets us 310. I'm willing to bet on that. I'm willing to say, hey, 10 or 12 in the long run, and the company's earning 18 in a rising, I'm fine with that. That totally makes sense to me. So again, I'm not putting necessarily a target, but sensitivity analysis tells me there's room for this to go higher. So there's my view on Microsoft. I guess one last comment. Look, it's down 1.4% today. That's not a massive opportunity by any stretch of the imagination. The stock has run up quite a bit over COVID. I would say you can still own this as a core position. So that would mean bigger weighting than most. That doesn't mean you massively add to it, like right here. If you don't own it, nibble away, get some, build this position. Hope maybe we'll get bigger pullback at some point. That's harder to predict than the long term, which is strange. But anyways, if you do own it already and you wanted to top up a little bit here, again, it's not a massive opportunity. It's just a tiny little pullback. But nothing in that quarter should change your view, in my opinion. Thanks for watching our investment video. If you want to improve your portfolio returns, simply subscribe. Or if you're an investment advisor or retail investor and you want help with your portfolio more directly, we can help you with a managed account and manage each and every trade for you.